Hello, this is Brian Rezny, president of Rezny Wealth Management. We're bringing you a great show again tonight, as always. We're going to talk about the government shutdown, of course, and the debt ceiling debate. A lot of questions a lot of investors have had probably the last week or so that this has been going on. It's unfortunate that our government officials act the way that they do, in my personal opinion, whether it's Democrat or Republican or somebody left, right, or in the middle. At the end of the day, the adults need to come to the room and actually act like adults and do what's generally right for the whole economy and the whole United States. I ultimately believe that our government will do what's right. It might take them an extra day or two or three, but just to give you a little information, and I know when you hear, oh, the government shut down, well, first off, the government actually isn't shut down. A small percentage of the government is actually shut down. The big problem is the debt ceiling. Now, we've raised our debt ceiling probably well over 90 times over the last 50 years alone. We've actually had 17 government shutdowns since 1976. Guess what? The world didn't come to an end. The U.S. didn't come to an end. In fact, it had very little impact on the U.S. economy on these government shutdowns. In fact, one of the longest government shutdowns lasted around 25 days or so, and the stock market went down about 3.5%. But abruptly after the shutdown was over, the market skyrocketed well over 10. Now, I don't know if that's going to happen this time, but I can clearly tell you I've been managing money and reviewing the economy and portfolios for over 27 years, and I've seen just about everything that has hit various investment markets. You know, we've had budget talks in the past, fiscal cliffs in the past, we've had wars, terrorist attacks, and at the end of the day, most of these things are very short-term in nature and have really no impact on the long-term portfolio returns for an individual as long as they're following an investment strategy. One of the things that we do at Rezny Wealth Management, and we do quite well, is called risk management, or knowing when to sell. We run a strict investment strategy, and part of our investment strategy is actually when to sell and reduce risk. Currently, and again, our indicators can change at any time, but currently we're fairly well invested for our clients at this time. We haven't really raised any cash given this government shutdown. Now, over the next day or two, things may change, but generally speaking, this government shutdown is probably going to be like the last 17 before it. It's going to be a moot point in a week or two from now, and investors will get on with their life. But one of the things I want to stress to every investor, and I get this question a lot, not only on my TV but my radio show, is how do I know if the person I entrust with my money is actually managing my money? We're going to talk about that right now. The first thing is buy and hold doesn't mean buy and forget. Too many investors, unfortunately, are using a broker with a title, whether it's at a big brokerage house or the local bank and the investment person at that local bank, or maybe the guy selling insurance products. These people generally are not money managers. These people typically act as a broker. When you have a brokerage account, which most consumers do, you have a brokerage account and you are actually responsible to manage your own money. So what happens is buy and hold tends to be the norm because the broker or so-called advisor sells you investments his or her firm manufactures and represents, and they sit in your portfolio. The only time you often hear from that advisor is when they want to sell you something else to generate another fee or commission, or when things drop 30 or 40% and then you're calling them hysterical and they tell you, hold on, things will come back. So at the end of the day, do you have a real money management firm, and is risk management part of the strategy that firm deploys for the safety of your retirement? Sell. Sell when your investment strategy indicates and when necessary. Too many investors, again, buy and hold because unfortunately they believe their stockbroker or their advisor actually manages their money. If you're not under a registered investment advisory agreement that includes money management, again, you would have a brokerage account. So the problem is you're buying and you're holding even assets you may not want to hold when they drop 30, 40, 50%, like in 2008. Part of your investment strategy needs to be when do you sell and start mitigating risk. And again, that's not after something's dropped 30, 40, or 50%. It's well before that. So again, Buy and hold is not an investment strategy. That's usually an indication that you're dealing with a broker and you have a brokerage account. You need to know what is the sell strategy so you can understand how that firm's dynamics work and how they could protect your portfolio from big declines, not these little bumps in the road. The investment market is not just the U.S. stock market and not just the bond market like your broker has you in. I can tell you from the investors that come into our offices, not only in Naples but in Fort Myers, every single week we talk to investors who have what we call the pie, the Wall Street pie. Everybody gets the same pie. You're generally in stock and bond related mutual funds in this pie, and it's almost always in the U.S. The problem is the U.S. is not the only place to invest, and stocks and bonds are not the only investment that you should be invested in or that should be looked at for your portfolio. Again, typically in a brokerage account, investors end up buying stocks or bonds or stock and bond related mutual funds because that's what brokers and brokerage firms like to sell. There may be other products in there like variable annuities or equity index annuities or maybe some other products that Wall Street has dreamed up. Normally, a lot of these products should not be in your portfolio. So I'm not talking about the product itself, but the asset category you own. So again, do you have a brokerage account? And if you do, and under most circumstances, I would say about 90% of the people that hire my firm, unfortunately, are misled that they believe their money's being managed when it's not, and it's inside a brokerage account in a buy and hold fashion with no risk management. I'm going to put my phone number at the bottom of the screen, and we had it up earlier, but we are lining up some phone calls right now. If you'd like to ask me a question about your portfolio, if you're concerned about a stock, a bond, a mutual fund, maybe you were the unfortunate recipient of bad investment advice from Mr. Annuity Salesman at that free steak dinner seminar, call me. We'll help you out. The number in the studio, 239-417-4711. All you have to do is call that number, talk to a studio producer. He'll take your question and he'll relay it back to me. You can also visit my website, ReznyWealth.com, and you can send me an email question that we'll read and answer on our today's program. John in Boca, Florida. Brian, love your show. Thank you. Do you feel the negatives are already priced into the economy from the shutdown in government? John, that's a great question. We're getting a lot of these questions, not only on my radio show on Sundays, but my TV, and also that are filtering through our office and our phone lines, of course. At the end of the day, again, this shutdown, I think, is going to be really a non-event, as a lot of other government shutdowns have been. I think you as an investor have to realize there's always something to worry about. I think the problem for investors today is it's hard for you often to turn off worthless information that basically is hyped and is repeated throughout the day. You know, if you look at news programs in general, if you look at the internet, consumers are inundated by all kinds of information 24/7. And there's not new information, you know, throughout the day. It's the same information, but basically you're hammered on this same negative information over and over and over again. Like I said, we've had government shutdowns in the past. We've had wars. We've had everything happen. And guess what? The U.S. economy is stronger, bigger, and most people, if you were managing your money correctly, are worth more money today than they were a year or 2 or 3 years ago. I'd say that's a pretty good positive. Again, that number's at the bottom of the screen. You can also visit my website at ReznyWealth.com. We've got a special report for you, by the way, how to avoid outliving your money during retirement. One of the things that's happened to too many retirees that we have seen throughout the state of Florida is bad investment advice. And that bad investment advice has led those people to buy things they should not have been sold in the first place. Often it's annuities, often it's structured products, often it's expensive mutual funds, and all these products come at a cost. The ultimate problem that investors face is, again, goes back to, do you actually have an investment strategy? Is the firm that you entrust with your money actually managing your money? And what is the risk management strategy involved in that strategy to reduce catastrophic losses? Most investors can handle bumps in the road. What you don't want to have happen again in the next recession is a 2008 type scenario where your retirement portfolio again drops 30, 40, 50%. We firmly believe risk management is an important part of money management at Rezny Wealth Management. So if you'd like to get a copy of that free report, go to my website right now, reznywealth.com. Tom and Darlene in Fort Myers, Florida. Our advisor said he's a fiduciary, but after listening to your show, we think he's lying, or worse yet, doesn't understand the difference. He's pushing an Allianz equity index annuity. Tom and Darlene, great question. First off, anybody who sells annuities, whether it's equity index or variable annuities for a commission, which is 99% of the time, is not a fiduciary. Quick definition of fiduciary, as an example, Rezny Wealth Management acts in a fiduciary capacity. We're a fee-only registered investment advisory firm. Anyone who sells commission-based products is not a fiduciary and is not working in a fiduciary capacity. So the person selling you annuities is not a fiduciary. In fact, he does not have to put your interest ahead of his. His interest could be far ahead of yours, and that's the problem in the sale of commission-based products, whether it's annuities, mutual funds, or other Wall Street gimmicks. At the end of the day, you always want to look for a firm that is fee-only, not fee-based and not commission-based, acts in a 100% fiduciary capacity, meaning they have a legal obligation to work in your best interest. Anybody who earns commission or sells commission-based products, again, is not a fiduciary and is not working in your legal best interest because they don't have to. They're allowed to sell you a lousy, expensive investment product, but unfortunately, most investors don't understand the difference between fiduciary and suitability. Tom and Darlene, my guess is either you're an annuity salesman who's not an advisor at all, either doesn't understand the difference between fiduciary, which is no shock because I've had clients that have hired my firm that were working with major Wall Street companies you've heard of, and when they asked their advisor if they were a fiduciary, some of these people actually said to them, "What's a fiduciary?" So again, a lot of these brokers are kind of brainwashed sometimes by the bad umbrella of Wall Street, and they don't understand what fiduciary means. They are well-intentioned sometimes, so maybe it's a lack of knowledge. Either way, if they don't understand what fiduciary is, or they're lying to you, is that really somebody you want to trust your money to? Probably not. Tony in Cape Coral, Florida. What do you think of investing in Japanese, in Japan, and any ideas? Tony, great question. You know, generally speaking, Japan's been on a tear all of this year. In fact, if you look at most of the Japan indexes, they're up around 20-25% in that range. And the reason is because Japan finally realized, hey, let's stimulate our economy like the U.S. started to do 5 years ago, after the 2008 credit crisis. I'll give you a couple ideas for Japan. First off, I would look at ETFs, exchange-traded funds only. Now, there's two that I'm going to talk about. One is EWJ, which is basically an ETF that buys the Japanese stock market, so it's well diversified. The other one is DXJ. This one basically is the one I would prefer you look at, and the reason that one is it's actually hedged. That ETF buys a similar basket of stocks as the first one, but it hedges the currency risk of Japan. And that's an important thing. So if you're looking at Japan, relative strong Japan's been through this year, so we like it for that fundamental reason. But generally speaking, we want to make sure we hedge the currency if possible, and the best way to do it would be that last ETF that I talked about. We do like Japan if they stay on the path that they're on and they keep supplying money to their economy. There's a good likelihood that hopefully their economy will slowly start to turn around and actually grow their GDP instead of being in a long negative 25-year downtrend in their stock market. I'm going to take a short little break. I'll be right back with more calls and questions after this, but please make sure you visit my website, reznywealth.com. You can download that free report, How to Avoid Outliving Your Money During Retirement. You can also sign up for a consultation with my firm. There's no cost or obligation. It's a great way to meet us, have us take a look and give you a second opinion about your portfolio. I'll be right back after this. Hi, I'm Brian Rezny. If you're like many investors, you've lost a lot of your retirement assets due to poor investment management or being sold investments that are often better for that so-called advisor than you. Most so-called advisors are just salespeople or brokers for investments their firms represent. No real advice at all. If you're tired of bad investment advice and are ready for positive change for your retirement, call my firm for a consultation. Don't settle for bad investment advice. There is a difference. Call us today. And we're back. I hope you're enjoying today's program. Of course, we were talking about the budget concerns, the talks about shutting down the government. Again, as I've talked about very often on not only my TV but my radio shows, there's always something to worry about as an investor. There's always something going on. So once this is past us, there's going to be another issue. I can guarantee you that. And at the end of the day, as long as we can grow the U.S. economy and the world economy continues to grow, I firmly believe there's going to be great opportunity, not just in the U.S. stock market, but in other asset categories not related to the U.S. stock market. So one of the things I want to mention is this. If you have that pie that shows up on your brokerage statement and you primarily have stock and bond related investments in the U.S., that's a failed strategy. We at Rezny Wealth Management do not believe in the failed pie. We don't believe in owning assets just because a brokerage firm wants to sell you those assets. We believe that you should own assets that are relatively strong and in an uptrend. We firmly believe risk management is an important part of money management, and there's times you need to sell and not be in the stock market in the U.S., but maybe in other asset categories around the world. So don't ever let anybody tell you, hold on, things will come back, because sometimes you need to sell. Tom in Marco Island, Florida. I have the failed pie allocation you described last week. My portfolio is $450,000 and I have a mix of mutual funds and ETFs, approximately 32 positions. It's done poor. What should I do? Sorry about that, Tim. This is what happens, and I see this a lot. When you're dealing in a brokerage firm arena, and clearly this kind of gives you an idea that you have somebody who probably doesn't have a lot of competence. When you get a pie and you have 32 investments in mutual funds and ETFs in a $450,000 portfolio, that's simply just crazy. What that person's doing is they're basically throwing the money all over the place, hoping that something works. Now think about this. If you have 32 positions in a $450,000 portfolio, each one of those positions represent how much of your portfolio? 2%, 3% maybe? So again, even if you own 3 or 4% of an investment, even if it does great and you have a bunch of investments that are not doing that great, it has no impact on your portfolio, meaning your portfolio is doing nothing. I've seen this happen a lot in the last 3-4 years. A lot of brokers or so-called advisors from the investment departments at the local bank or from the Wall Street companies, what they're doing now is, because they're scared and they don't know what to do for their clients, they're putting you in more and more and more of the same asset. So as an example, by having a $450,000 portfolio, and let's say owning 6 mutual funds and maybe 6 ETFs will have you well diversified, what they're basically doing is buying basically 15, 16, 17 mutual funds that are all kind of the same, and 16 or 17 ETFs that are the same, and all you do is have the same of the same of the same. What that basically does, it doesn't give any more diversification, but you're watering down the good investments with stuff that is not so good. I can personally tell you, managing money for 27 years, I have never seen 32 mutual funds or 32 ETFs that I'd want to have in the portfolio that are all great at the same time. Maybe there's a half a dozen or a dozen, but once you get past about 5 to 6 asset categories or mutual funds within a portfolio in a similar category, it doesn't actually reduce your volatility, it reduces your return. That's what our research has found. So what I would tell you, Tim, it sounds to me like you just got a bunch of garbly gooked portfolios, kind of like a garage with no real direction. I would suggest you call my office in the morning. We'll put our office number at the bottom of the screen. Call us for a consultation. We do have an office in Naples, and we do have one in Fort Myers. You can also visit my website, ReznyWealth.com, and sign up for a consultation there. We do handle portfolios of your size. We would be more than happy to sit down with you, do a review of your portfolio, and show you the benefits of Rezny Wealth Management and how we can help improve a bad situation. I could pretty much assure you that there is a difference in investment management styles. You clearly have too much overlap, and you're not gaining any traction. Sally in Naples, Florida. How to invest when everything seems risky? Sally, great question. I hear that maybe once a week, twice a week from various callers that call our office or from one of my TV or radio shows. The bottom line is there's always something that may be appropriate. Sometimes that means a money market or cash. Right now I can tell you this is what I see in the global landscape. I see the emerging market economies getting a little bit better. I see the U.S. economy getting a little bit better. I see Europe actually starting to grow again. I'm seeing improvement, generally speaking, around the world. Now, it doesn't mean that you're just going to invest in the stock market, but there's other asset categories as well. At the end of the day, there's always negative news, and I think what hurts too many investors today is too much negative news. What happens, Sally, is this. Negativity, problems, sell advertising. And so a lot of these programs hype a lot of the problems and the issues but give you no real solution. That's why we started our radio and our TV show. We want to give you solutions so you can get past the noise and you can make better decisions about your portfolio. Like my last caller, Tim, I would suggest you call my office, make a consultation, let's sit down and talk. I think what you need is a real investment strategy which includes risk management. We can explain how we manage portfolios and how we can control some of the risk. That would give you more of a comfort factor to maybe do the right things with your money and actually give yourself a chance to make a return on your money. Dan in Fort Myers, Florida. Love your show. Thanks, Dan. Can your firm handle smaller portfolios of $200K? And what would you recommend for growth within a 401k plan? Dan, again, thanks for the nice comments. We always appreciate nice feedback. And of course, if you have questions about your portfolio, you can visit my website, send us a question. We'll read an answer on the TV or radio show. You can also go to our website for that free report, How to Avoid Outliving Your Money During Retirement. To answer your question, Dan, we can handle smaller portfolios in that $200,000 range. That's not a problem. If you're trying to grow your 401k plan, let me tell you the inherent problem with most retirement plans. Lack of investment options, quality investment options. And again, you are 100% on your own when you are in a 401k plan to pick and choose your own investments. Some of the companies that give you kind of that pie-shaped allocation, which I don't think is all that positive. So what you really need to do is take a look at your goals and objectives and what you're trying to do with this money. If you do not need this money for at least 5 years or more, and you're trying to grow it, I'm going to assume those are your circumstances, Dan, I would look at more growth-oriented investments. Look to see what options your 401k plan has in small cap and in mid cap. If they have any options in the emerging market economies, that would also be a plus. So what I would say, if you're trying to grow your money, maybe keep about a 40% weight in small cap, about a 40% weight in mid cap in the U.S., and maybe 20% in emerging markets. That would be a growth allocation. Again, this is assuming you don't need any of that money for at least 5 years and you're trying to grow it. Depending on your age and your risk profile, you may reduce that strategy a little bit, but generally speaking, most 401k plans have the options I just discussed. So you really need to review the options they're giving you. What you could do is you could actually call our office, schedule a consultation. We can talk to you about maybe your portfolio and your other needs, and maybe we can give you a better general handle on what you need to look at within that portfolio. If you're like my last caller and you've got a question, I know we're getting close to out of time right now, but we have time probably for another call or so. Please call us in the studio right now. We'll put our number at the bottom of the screen just for a couple seconds, 239-417-4711. And please visit our website, ReznyWealth.com. You can sign up for a consultation at either our Naples or Fort Myers location. We would love to sit down with you. We are a fee-only registered investment advisor, a money management firm. A big part of how we manage portfolios is risk management. So if you're unhappy with lack of investment strategy or maybe being sold investments that are better for that firm than for you. A fiduciary firm has to work in the legal best obligation for the client. That's what Rezny Wealth Management does every single day. Chris in Fort Myers, Florida, first-time listener. I'm working with a Ameriprise advisor, and he wants me to put $550,000 401k rollover into a RiverSource variable annuity. What do you think? I think that's a huge mistake. First off, your Ameriprise advisor is not a fee-only registered investment advisor fiduciary. He's selling you an annuity. That RiverSource annuity is a sponsored manufactured annuity owned basically by Ameriprise. So their people are required to basically sell their own products. I can tell you from a lot of experience, and I've had many people that have owned RiverSource annuities. They're not the best, and they are far from the cheapest. A big mistake would be taking your 401k plan that's already tax deferred and stick it into annuity. Big mistake. I can tell you from personal experience, researching these RiverSource annuities, the average one that we've looked at had an internal expense ratio between 3.5% and 5% a year. That's highway robbery and cost, bottom line. You can get professional money management from a firm like ours with a low-cost structured portfolio for a fraction of that. The problem is annuities insanely lock your money up. They are extremely expensive against the returns on your money, and often the investments are lousy. So again, you have high expenses, you lock your money up with very limited withdrawal features, and you have lousy investments or mediocre investments. Stay away from annuities, and what I would suggest you do, again, call our office for a consultation. We don't sell annuities. We're not a broker. We're not an annuity salesman. We are a fee-only fiduciary registered investment advisory firm. We have a legal obligation to work in your best interest. We would love to help you do the right thing with that portfolio. Give our office a call. At the bottom of the screen, by the way, I'm going to put our website up, ReznyWealth.com. You can go there, sign up for a consultation. You can also sign up for our newsletter and download our free reports, whether it's our fiduciary questionnaire, whether it's how to avoid outliving your money during retirement. And by the way, we have a special report in our article library, Why Annuities Are Dangerous to Your Wealth. Folks, I'm just about out of time. Call us for a consultation. We'd love to talk to you about your money management needs with a firm that's only interest is to help you grow and protect your retirement portfolio. We'll see you next week.